Market cycles. We hear this a lot. The market goes up and down and it goes through cycles. Why? What does that mean and how does it work? This is what people talk about when they say there's buying opportunities or you should sell or you should not be buying. A lot of it turns out to be predictions, which I do not like. So let's dive into market cycles. Since 1928, the S&P 500 has had 27 bear markets. And every single time, everyone said it's different this time. And every single time the market recovered, it wasn't different. Now, the cause may have been different, but the outcome's still the same. Let me make this clear. Understanding market cycles is not about prediction. It's about knowing that they are not only normal, they are expected, they are temporary, and what's happening. This allows us to not make simply emotional decisions and read headlines and come to conclusions about the market cycle. That is the worst way to invest. And the simple knowledge and how you act within market cycles can produce millions. But every market cycle follows essentially 4 phases. Phase 1, accumulation phase. Smart money buys after a crash. Prices are low and pessimism is high. Everyone's scared. Phase 2 is the markup phase. Prices rise, news improves, and more investors start to join in, and the bull market begins. Phase 3, the distribution phase. Smart money starts to sell. Euphoria sets in. This time it's different. It's not going to go down. It's not going to crash. And that leads us to the 4th phase in the market cycle, the markdown phase. Prices fall, panic selling begins, the bear market ensues, and the cycle repeats. Now, what does this look like in terms of numbers? The difference is staggering. The average bull market lasts 5.5 years. Now, after 2008, we had the longest bull market in history. But the average gain for that 5.5 years has been 186%. The average bear market lasts 1.3 years. The average decline is only 36%. That means time spent in the bull market, the up phase, is 78%, where the down phase is only 22% of the time. The key takeaway here is that markets go up way more than they go down. Winners stay in the game, and it's not different this time. Now, market cycles are broken up into 2 major cycles. You have short-term and long-term cycles. The things that drive the short-term cycles, or what we would call the business cycle, is principally driven by the central banks and interest rates. Things get overheated, they raise interest rates. Interest rates slow the economy down, people get laid off, asset prices come down. The money is shrinking. Interest rates go down, money expands, asset prices go up. The interest rates are driving those short-term cycles. Long-term cycles are different. The short-term cycles, we're talking every 5 to 7 years. The long-term cycles are more like 70 to 100-year periods. These are major debt cycles. The end of them represents the Great Depression, 2008. Now, this is when the market is not being controlled by interest rates anymore. Think about 2008. They dropped interest rates to basically zero, and the market didn't change. So what does that look like in historical context? The Great Depression was an 86% drop. Now remember, the average is only around 35%, and it took 25 years to recover. 1987, Black Monday, a 34% drop, but it recovered in 2 years. Financial crisis of 2008. We had a 56% drop, and it recovered in 5.5 years. Now, 2020, COVID, a 34% drop, and it recovered in 6 months. You can see the difference between the short-term and the long-term cycles. Even though the cause may be different, the outcome's still the same. So what are warning signs of market tops, and what are signals of market bottoms? At the end of the day, when we look at the prices and the actual earnings or income that is driving the value. When those things get out of whack, meaning income of the actual asset, the underlying asset, isn't going up anymore, but prices still are. For the stock market, price to earnings ratio, those two things, after you get to like 30 times the price to earnings, you start to go, wow, these are really, really valued high. Today, that sits at 39.1. That is comparable to the dot-com bubble. Another market top signal is like IPO frenzies. You just have all these people and SPAC manias, and you just got people pouring in, launching companies to the market, making tons of money. This accelerates at the top. This time it's different narrative. When people start saying this time it's different, you should be worried. Retail investor enthusiasm. When average people start talking about all the money they're making and how much they're investing, that is almost always the signal of a market top. It represents the lack of fundamental analysis, and retail investors are buying what institutions and what is called the smart money is selling. The inverted yield curve. That is a change in the pricing of long-term versus short-term debt. When those go inverted, it means that people are much more skeptical about the short-term versus the long-term. But remember, market timing is impossible. The thing that I really look at and focus on is the price to earnings, or that price to income. I like to say that I don't time markets, but my money does. Meaning that I set a strict box of what I need to make and the price that I'm going to pay for it. And when it gets out of whack, it doesn't meet that number. I don't know if it's going to end or not, but I have a very defined thesis and buy box. So all of a sudden, I just can't buy as much because it's out of whack. But then when prices go down, the price to income changes, and that gets out of whack, and all of a sudden I can buy more. I'm not timing markets, but my money is. That's what we're doing today. We've bought more this year in commercial real estate, specifically self-storage, than we have bought ever, only compared to when I was buying in 2010, 11, and 12. The reason being is the price is below replacement cost on great, incredible assets. We're buying undervalued properties that aren't trading rationally. So what you need to do, understand the drivers of market cycle, like capital flow, where it moves and where it's going. Keep things basic. We're talking about interest rates. Are they going to go up or are they going to go down? That will drive market cycles. Stay invested through market cycles. Don't try to time, just buy more or buy less. When crashes come, remember it's not different this time, and take advantage. Don't let your emotions control your investing thesis, outcome, or what you'll do. Dumb money sells at bottoms and buys at tops. This is a major driver of investors. They see things are bad from headlines and now all of a sudden sell, get out, get rid of it. And they see things are good at tops and they want to pour all their money into it. Emotionally driven by feedback that they're receiving from the state of the economy, which lags investments and isn't a reflection of actual market cycles. Rebalance often to maintain your allocations. When things get out of whack, don't be afraid to take money off the table. And when things are down, don't be afraid to buy. At the end of the day, you can't predict market cycles, and nor can I. But that doesn't mean we can't take advantage of them. Let me know, what is your guys' indicators of market tops or bottoms, and what's your strategy in the comments? And make sure you like and subscribe so you can learn more about how to take advantage and create wealth.